Okay, good morning and happy Tuesday, everyone. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we have a lot to cover with the market. So let's go ahead and get started. Now, before I do, a disclaimer, what we're going to discuss here today is purely for demonstration purposes and not a solicitation to buy or sell any specific securities. So today, looking at the current market outlook, we've discussed this for quite some time here for quite a few weeks, and I'll talk about Texas Instruments here in 1 second. But we've had the very strong sell-off during the coronavirus, subsequent rally. What's interesting is that last week, the markets tried to push back above into that 20-day moving average, but got rejected. And this week is starting to gather strength again. We're seeing quite a bit of bifurcation here between the weekly and daily charts. The daily charts remain fairly strong. Every time it rallies up into that 284 area, gets rejected, touches the 20-day moving average, rallies again, touches the 20-day moving average, and is starting to rally off again. 284 has really been this kind of battleground level here where there's a lot of trading above and below it. We expect that to happen for quite some time, especially since you have a lot of investors throughout this area that have accumulated stocks last year between April and November that are looking to potentially sell their stocks at break even. So every time the market rushes into this area, you're going to see waves of selling. When it gets below it, you're going to see markets continue to rally higher until the stock breaks below the 20-day moving average. Then we might start to see some acceleration and momentum to the downside. But until we do, we certainly expect that this market is going to continue to try to battle around this 284, potentially as high as 302 on the S&P 500. So that is the theme that we've been having for quite a few weeks now. Kind of buy the dip, sell the rallies, kind of, and you have to be very nimble because you're likely having to switch positions between long and short very quickly, especially if you're trading options. So most of the strategies that are working right now is really selling premium, selling put spreads when the markets get to some a sort of support level, and start selling call credit spreads here. Especially for those of you that have watched my credit spread webinar, this is exactly the type of market environment that we talk about are ideal for selling credit spreads. When markets reach that support level, you sell put credit spreads. Every time it reaches a resistance level, you sell call credit spreads. And many times you can string these together. So as the markets rally higher, you sell a call credit spread. As they rally lower, you sell a put credit spread. So especially for those of you that have watched that webinar, I highly recommend you to go back and watch that if you have not taken a look. So we've talked about this battle at 284, 285, which is a major resistance level. We expect that to presume for quite some time until if the markets get above 302, then we would certainly say that we're back into the strong risk on environment. But until then, we're kind of in this flip-flop between risk on and risk off. We've been talking about the VIX for quite a few weeks. It keeps going between contango and backwardation. Right now it's back in contango where the front month VIX is trading lower than the 3-month VIX. So we're currently in this risk on environment, again, this flip-flop back and forth between the two very quickly. We haven't talked about COVID-19 trends for a while, simply because the markets have completely dislocated from COVID-19 trends. But I do want to point out one new chart that I think is important for us to look at, especially as we're trying to understand when things are going to get back to normal, and we're thinking about when things are going to reopen, which is very sensitive for a lot of stocks like travel stocks, restaurant stocks, consumer discretionary stocks, even consumer staple stocks that are going to benefit if things remain in lockdown for longer than anticipated. So I want to take a look at some of that. I want to take a look at some of the commodities that give us a better sense for industrial demand, because this continues to remain weak. And this is, again, the disconnect that we continue to see in this market is the disconnect between economic numbers in terms of industrial demand, when things are going to get back to normal, with the equity markets. And in order to understand that a little, what we're going to do is we're going to review all the sectors today. We haven't taken a look at all the sectors in a while, but there's a clear bifurcation in the sectors. We're clearly seeing rotation in the sectors. So we want to point out where we're seeing rotation and seeing why we have this kind of battleground market currently with the markets if we look at the individual sectors. So I'm going to start off by talking about the COVID-19 trends. there's been a lot of focus on New York City because in New York City it was the epicenter. There was about 50% of the cases, 50% of the deaths was in New York City. So as soon as New York City started to peak, that was really when we started to see equity markets really roar back to life. We had the best month for the S&P 500 since 1987 off of this optimism. But if you look at the rest of the United States, it certainly started to look like it was peaking around the same time, but recently has really started to accelerate again. And this is concerning because we have a lot of states and cities that want to get back to normal, that are starting to reissue or that are starting to open up their economies. And this may be a short-term optimism, but the data shows us something quite different, that the number of cases continue to rise, that we actually expect the number of deaths per day to continue to rise quite for at least another month, possibly 2 months. And this really puts or pushes back the timeline of when people might feel comfortable to get back into a restaurant, get back on an airline, and continue to go shopping at their grocery store and cook at home and work from home. So the bifurcation that we're currently seeing in the market may continue to go on actually significantly longer than some of us anticipated. Is certainly even a couple of weeks ago, I think this data looked a little different, and we're starting to see some new cases. And again, this speaks to the disconnect that I currently see between this type of data and where the equity markets are trading. So in order to understand some of that, let's take a look at some of the real-time indicators that we've been looking at. Oil obviously being a very good indicator of economic demand across the world. Now, oil has provided a little bit of stability over the last few trading sessions. So we've kind of had this bottoming formation here, and as we continue to move lower, momentum actually has continued to move higher. That's actually a good sign. Oil being back above $20 is the first time it's been back above $20 for quite a few weeks now. And the question is whether or not oil can sustain this type of rally, or it's going to start to sell off, because we're starting to see a bit of strength here in energy. Energy has been the weakest sector for over a year now. And the question is whether that relative strength is starting to rotate out of energy into some of the other stocks. So that's really why we want to take a look at the whole sector view this morning. I'm just going to look at charts for every single sector and show you where they all stand. But another one that has continued to bug me is we've been talking about the gold silver ratio. We've talked about it in options action. I think many of you may have read research on this, that the gold to silver ratio has reached an all-time high. It seems like we talk about reaching an all-time high every week, and we've been doing this for weeks now. And yesterday, the gold silver ratio reached about 116. So you can buy 116 ounces of silver for 1 ounce of gold. And part of the reason that we're seeing this significant increase in the gold silver ratio comes down to two things. One, there is a huge demand for gold as a hedge against inflation, as central banks around the world continue to pump liquidity into markets and print money. We've seen rally into Bitcoin, we've seen rally into gold as a result of this. And at the same time, you have a weakness for silver, because silver is not considered a precious metal in the same way that gold is, and certainly not used as an inflation hedge. And silver is predominantly an industrial metal. And when industrial demand is down, silver prices go down. And we're seeing that continued weakness in silver. Gold being near relative all-time highs. Silver is nowhere near those relative all-time highs. Is actually recently got rejected at the 20-week moving average and is starting to move lower. Daily charts have actually not even managed to continue to make higher highs. It's actually making lower highs and started to break down again yesterday. So silver continues to show weakness here. So we actually expect the gold silver ratio to continue peaking and actually get higher in the next few weeks. But again, the silver actually declining here, below $14 speaks to the lack of industrial demand for goods around the world. So this again speaks to more of the disconnect that we're currently seeing in the markets. So let's take a look at the individual sectors. So I want to start off by taking a look at some of the strong sectors. Healthcare. Healthcare has remained incredibly strong, mostly boosted from the fact that most healthcare stocks are not as sensitive to consumer spending. There certainly have been quite a few healthcare stocks that have benefited from creating or trying to create vaccines or cures for the coronavirus. I do think that if you want to play that type of theme, you're better off using some of the biotech indices like IBB, which I've spoken about quite a bit for the last few weeks. But healthcare has seen a substantially strong rally here after the sell-off, back above its 20-week moving average, came back to retest that as support, and looks like it's finding a little bit more support. So the weekly chart finding support around the 20-week moving average. The daily chart also, same thing, continues to make higher highs, higher lows, retested this 20-day moving average, and looks like it's starting to potentially move a little higher. At this point, it's really hard to say as far as how much higher these markets can go. We certainly think that there's a limit as far as how far these stocks can go. Our preference, again, to play these types of markets is when you find this type of support, you sell put credit spreads. As you reach these types of rallies, you sell call credit spreads, and play this kind of ping pong game, if you will, that the markets are currently trading in. These are what I would consider ideal conditions to sell credit spreads. And you want to sell credit spreads because these have limited risk, right? So if you sell this put spread here and the markets instead just starts to take a dump because of whatever catalyst that might cause that, you want to do it in a way with limited risk. And right now you can pick up quite a bit of premium. Normally when you sell these credit spreads, you're risking twice as much as you would typically collect on a premium. But with the high volatility environment that we're in, you're typically only risking 1.5 times the credit that you're receiving. These are prime times to collect premium. Especially, you might use that premium at some point if the markets start to correct lower to buy some puts. So again, this is the type of strategy that we're predominantly using here in this type of strategy. Technology, also one of the strongest sectors. And Anita, I'll try to answer your question at the very end about an example of a credit spread. But we've been selling credit spreads predominantly in the daily plays that we've been sending out. Electronic Arts, Activision, these are all credit spreads that we're selling. Technology managed to peak back above the 20-week moving average, so we certainly see some pretty strong support there around that 20-week moving average. Daily chart looks very similar to the healthcare sector, continues to make higher highs, higher lows, bounces off the 20-week moving average, may continue to move a little higher into that $94 area, but I think 94 certainly is a major resistance level for technology, as it kind of tested this level multiple times in the past. So I certainly expect that when it reaches the 94, it's going to find some resistance here for technology. So I don't know that there's a whole lot of room to the upside. Again, that's why we're selling put credit spreads as opposed to buying call options, because buying calls requires a big move to the upside in order to be profitable. Selling put spreads, all you need is for the stock to stay in this particular area and you'll be profitable selling that put spread. So again, both from a volatility and a directional perspective, that's why our preference right now is still selling credit spreads. Industrials, completely different picture. Hasn't even managed to rally back up to that 20-week moving average, showed quite a bit of weakness last week, and is still continued to show weakness here. Industrials barely hanging on to continuing to make higher highs and higher lows, but as you can see, momentum has predominantly stayed sideways throughout that small rally. So industrials, one of the weakest sectors. Again, this speaks to the lack of industrial demand. If you look at silver, you look at oil, that's the same chart that we're currently seeing with industrials. And industrials, a major support level here around 61 going back to December 2019 sell-off. It's barely flirting with that area. So significantly weaker as a sector compared to most of the other stronger sectors that are close back to February 2019 highs. I'm sorry, February 2020 highs, versus some of these stocks like industrials or sectors like industrials have barely made it back to that December 2019 low. So very different story across the sectors. And that's part of, again, why we're seeing this kind of battleground with the markets, because you have some really strong sectors versus some really weak sectors that are just playing back and forth, and we're seeing some rotation around it as well. Real estate not only weak in terms of getting rejected at the 20-week moving average, but breaking down below the 200-week moving average. Real estate actually not being able to make higher highs, actually making lower highs. So certainly one of the weaker sectors, starting to see rotation out of this sector, peaking below the 20-day moving average here, still below the 50-day moving average. So we might start to see this particular sector continue to see some weakness here in real estate. Not a big sector in terms of the S&P 500, but certainly one to keep an eye out for. Energy seems to have found a little bit of a footing here. Energy clearly has been a loser for a very long time. Well before the coronavirus, the sell-off during the coronavirus barely managed to rally much. So it looks like at this point it's gathering a little bit of strength to try to get back to that 42.5, which if you look at the daily chart is a big gap to the downside, where it gapped below 42 down to that 37 level or so. So, as oil continues to, or energy rather, continues to make higher highs, higher lows, finding some support around the 20-day moving average, I think it's going to gather enough strength to get back to that 42.5. Right now, it's yet to see as to whether oil will continue to stabilize and stay at these levels, or it might correct lower again. But certainly momentum is confirming this move to the upside. So again, I see that there's a fair amount of strength that it might push this back up to that 42.5. Energy starting to see some rotation into energy here very slowly, especially as oil starts to stabilize. Communications also starting to see some legs here. Managed to break back above the 20-week moving average. Think about stocks like Verizon and Netflix that are continuing to rally. That's what's dragging the sector higher. Not only is it continuing to make higher highs, last week the pullback actually didn't even retest the 20-day moving average. So I think that you might see some strength here. The 200-day moving average sits here right around $50. So you want to see that clear above 50. Once it does that, I think you might get some acceleration to the upside. But until it crosses back above that 200-day moving average, you might see a little bit of a chop here in between 49 and 50 or so on communications. But think about Netflix. Think about stocks that, generally speaking, may do well during the coronavirus in terms of lockdown. So that's why we're seeing some continued rotation into communications. Utilities, a defensive sector that we quite like during the sell-off and in the subsequent rally, is starting to see some rotation out. Got rejected at the 20-week moving average yesterday, a couple of weeks ago, and it's continued to actually show weakness while the markets continue to slowly grind its way higher. As you can see, utilities not managing to make higher highs, actually making lower highs and lower lows, and momentum is starting to roll over here as well. So we're clearly seeing a rotation out of these defensive sectors. Utilities, we're also going to take a look at staples, where we saw some strength during the sell-off, has started to rotate out of it. So we're going again back into this risk-on environment. We're rotating and buying cyclical stocks like technology, healthcare, discretionary. Those are the stocks, and communications seeing strength, whereas opposed to utilities and staples really starting to see that rotation out, where we were expecting to see some rotation in as we head into a recession. Kind of the equity markets shrugging off the concept of a recession, shrugging off the idea of 30 million unemployed, and really not playing this defensive play. Can this all unravel fairly horrifically? Possibly. It's really hard to say right now, but we're certainly coiling up into this type of potential catalyst here. What that catalyst is, hard to tell, but we're starting to see the same thing in staples. Staples looks very similar to utilities. Staples originally did manage to get back above the 20-week moving average, but subsequently got rejected and starting to move lower. I think there's quite a bit of there's a little bit of downside here down to the 200-week moving average. Similar chart here as utilities cannot make higher highs, actually continues to make lower highs and lower lows. Is it going to break down to the downside as momentum continues to slow down on these rallies? It's just trading below its 20-day moving average, so this is certainly concerning here. It might find a little bit of support here, but again, momentum really starting to slow down here in the defensive sectors with staples and utilities. Discretionary, continuing to see a lot of strength. One thing I do want to continue to point out is that discretionary, as far as XLY itself, we call it the discretionary sector, but 40% of the weight, 40% of the weight is two stocks, Amazon and Home Depot. We know Amazon is doing quite well as an online retailer. We see from the Bank of America credit card data, we see that online retail remains one of the strongest sectors and actually has seen uptick in consumer spending because consumers that are not spending in physical stores are spending it on Amazon and Home Depot. Home Depot, as people stay at home, are likely to work on projects around the home. So we've actually seen home improvement credit card data also continue to grow as opposed to contract during this coronavirus. So with Amazon and Home Depot being the predominant 40% of the sector, we're seeing the discretionary sector look particularly strong. But I think that if we really look into the discretionary sector, and this is something that Carter talked about a few weeks ago when they put out a short on XLY, is that if you look at the equal weight index, meaning if you look at the discretionary names across the index, the equal weight index is somewhere down here. It's not nearly as strong because, again, most of this index is actually Amazon and Home Depot. So this chart, in my opinion, is actually quite misleading because what this really shows is that Amazon and Home Depot are doing really well. Starbucks is also included in there, which isn't doing too bad. But all the names, Macy's, Nordstrom's, they're just smaller cap names and they're doing really terribly, but there's such a small component of the index, they're not really dragging the index down. It's actually Amazon and Home Depot that's dragging this index higher. So again, a little misleading here, but discretionary rejected at the 20-week moving average, looks like it's gathering strength here to make a push back above that 20-week moving average. Daily chart remains fairly strong here, continues to make higher highs, higher lows, pulled back to that 20-day moving average. Looks like it's gathering strength to at least try to get back to that 200-day moving average. The question is whether or not it can get back above the 200-day moving average and how much higher Amazon and Home Depot can continue to rally. Momentum certainly seems to slow down a little bit here on subsequent rallies here. So maybe this discretionary sector may be close to a top here. But the central theme here is still the fact that rotation in the markets have clearly rotated into the more cyclical sectors and out of the defensive sectors, utilities, staples. So as you look for opportunities in this market, at the moment, that is where you want to focus your attention on the more cyclical sectors, cyclical and stronger names in the cyclical sectors. If you're going to short the weaker names in the staples and weaker sectors. At this point, energy is also starting to turn around, so be careful there. Financials remains one of the weakest sectors. This predominantly, in my opinion, is due to the fact that interest rates have not lifted off. Financials, one of the weakest sectors during the sell-off, is still well below that December 2019 low, similar to energy, similar to industrials. Financials have really been kind of range bound here in this 22, 24 level. So again, great opportunities to sell credit spreads as it kind of reaches that bottom. Sell put credit spreads as it reaches the top. Sell call credit spreads. This is the type of strategy we've been talking about for weeks here for the market outlook session. This is the type of strategy that we've been predominantly using for our daily plays, again, because especially when the market's at these particular levels, we don't see a strong case for markets rallying significantly higher. So we're selling put credit spreads when things are low. And then when things rally to a resistance area, we feel there's going to be a fair amount of selling, which is why we're selling those call credit spreads. We don't see a catalyst right now that's going to shift the markets substantially away from that 284, 285 level. So as it rotates around that 284, 285 level, selling put or call credit spreads are the strategy to utilize right now, especially when volatility still remains fairly elevated. VIX at 34 is almost triple where we were back in February. VIX was trading around 11, 12. So at 34, you're gathering substantially more premium, even at 34. I know we were at 80 a month ago or 2 months ago. But 34 is still fairly elevated, but financials really struggling to lift off again, because interest rates have not lifted off. So I don't expect financials to really rally here. I think we've just covered communication, so we'll just talk about materials. Materials also seeing a little bit of strength here, but there's quite a bit of, again, bifurcation between the weekly and daily charts. Rejected the 20-week moving average. Looks like it's starting to try to gather a little bit of strength to start moving higher. The daily chart looks fairly constructive, continues to make higher highs, higher lows. Every time it reaches the 20-day moving average, it seems to bounce off. Again, momentum is certainly slowing down a little, but it's still confirming these highs. One of the things you will notice on many of these charts is that on the weekly chart, as the stocks rally substantially from that low, money flow actually remains negative or fairly weak across the board for most sectors. So this is, again, one of the reasons why I think there's limited upside here as far as how far stocks can go. I certainly don't expect the markets to get back to 302 or higher because of this weak money flow. And that's what we're predominantly seeing across the sectors. And just a quick look into earnings and liquidity. So again, just to remind everyone, you can access our earnings and liquidity link from your OptionsPlay platform now. So on the bottom of your platform, there is now a link to both the liquidity and the earnings calendar that you can access at the bottom of your screen. So when you access your OptionsPlay platform, you will have both the liquidity and earnings link at the bottom that will give you access to the earnings calendar as well as the liquidity report. Let's just take a quick glance at liquidity at the moment, but certainly continuing to improve here. So let's see, this was, oh, actually liquidity has actually pulled back a little. 141 very liquid symbols. I think late last week, we were looking at about 180, 190. So fewer very liquid symbols to trade right now, but still plenty of symbols to play around with. The earnings calendar, you know, the bulk of the mega cap stocks have reported now. So now we have a bunch of other sectors now. Today we have Activision, Disney, EA. Some of the names that we have some positions in, Beyond Meat, also one that I'm looking at. PayPal and Shopify and Square, ones that we have positions in. Uber reports tomorrow, and then there's not a whole lot in terms of the big cap stocks next week. You have Home Depot, Walmart, Target, so some of the major consumer stocks, discretionary stocks, John Deere, some of the technology stocks, Workday, Costco the following week, CRM or Salesforce, Zoom. So you know, you have the big mega caps have now reported. So markets, I don't expect to see, you know, from at least from these names, to create big moves in the underlying market. I think you need some other catalysts to knock this market either significantly higher or significantly lower from this 280, 290 zone that we're currently just battling over. And again, if you look at the sectors, you kind of see why. You start to see this rotation out of defensive. So you don't have a strong move in one direction or another. So with that, that covers what I wanted to show you guys here today. I do have a few minutes to try to answer a few questions here. Tony, Wayne is asking, why in this environment better for selling credit spreads in the dips and rallies instead of buying debit spreads? So debit spreads require a significant move, right? So we're not seeing significant moves. We're really seeing, you know, a few percentage points in one direction or another. You certainly can find individual names that are going to make big moves, and I'm not saying that doesn't exist. You know, we actually talked about Zoom on Friday, and I was saying that, you know, at that 135 level, you might get a nice bounce higher. But when you do get the $7, $8 bounce, you know, in a single day or two, you can buy a debit spread. But generally speaking, we're not seeing big moves. That's why we don't want to buy debit spreads. We tiptoed into our first debit spread today with Home Depot, looking for a move higher here because Home Depot reports earnings. So I think Home Depot has a catalyst to potentially move higher here. But aside from that, if there's no strong catalyst, selling credit spreads is better, because if the stock just moves a little bit higher, a little bit lower, you're able to take profit on that particular trade. So I hope that answers many of your questions, because I think many of you asked the same question here. Steven's asking, TDOC, thoughts about your vertical put spread? So we've already exited TDOC. I know some people re-entered this trade last week on that weakness, and I think that was actually a pretty good entry. You know, I certainly entered Zoom, and I think it's a very similar type setup here. I will say that, you know, I don't know how much more momentum this stock has. You know, as you can see, continue to move higher. As the stock continues to move higher, momentum actually is getting weaker.
Relative strength looks okay. From a relative strength perspective, it continues to make higher highs and higher lows. So that's okay, but I would be careful. Every subsequent sell-off, I think, is going to get weaker here. I think you maybe have one last shot to the upside here on TDOC. Now, I will say, if you look at the coronavirus trends, right, and you say that maybe we're not looking at a Q2, Q3 recovery, we're looking at a Q4, Q1 recovery, that might provide some additional support, because if you look at the numbers for Teladoc, they are fairly strong in terms of the number of new clients that they've received. And at this point, a lot of the research that we were looking at was expecting that growth in clients was actually going to decrease in Q3, but perhaps that this actually continues for substantially longer and you see support for these types of names. Someone wanted to take a look at Texas Instruments. So we have a short position here in Texas Instruments. It's doing exactly kind of what we're expecting, which, we sold the 115, 120 call spreads. We want this to stay below 115. Looks like it's rallying a little bit today here. So but momentum still remains fairly weak. It's got rejected at the 20-week moving average, still trading below the 20-week moving average. 115 is a major resistance level that we currently see, and we expect this to stay below it. So we're going to hold on to this at least for the next couple of days. If it weakens a little further today, I certainly might consider taking up profits on that particular trade. Thoughts on creating bullish trades in the gaming sector? I don't know if you mean gaming in terms of casino stocks or gaming in terms of like Electronic Arts and Activision, because we certainly are taking bullish positions in those gaming stocks. Casino stocks, looking at that COVID-19 data, I'm not particularly bullish on this just yet. The same way I'm not particularly bullish on the travel stocks just yet, because, when we look at the airline stocks, the longer this goes on for, the worse it really looks for a lot of these airline stocks. When they're looking at Q3, Q4 recoveries and people getting back on planes, I actually think that that's not going to happen. I think it's closer going to be 2021 before the average person feels comfortable enough to get back on a plane and get back to Vegas here. So that's my concern here. So gaming stocks, Take-Two, EA, Activision, we're very bullish. We had an EA position that last week. We're long Activision, which is doing fairly well today. Same thing with Take-Two. Take-Two is probably the weakest of those names, but still is relatively strong compared to the overall market. What's your take on Delta? I think the same thing with Wynn and some of these casino stocks. They seem to look like they're having some strength, but I don't know that strength is going to last very long. What's your views on Visa? Visa, very sideways market, really struggling with relative strength. Same thing with MasterCard, American Express. American Express probably the weakest of the two, but, relative strength really starting to weaken here. It's not really making substantial highs, but it is continuing to make higher highs and higher lows. But as you can see, momentum is really kind of moving sideways. It's not really moving higher. So I think you're going to struggle at that 200-day moving average. It might peak a little higher above it, but I think you have so much, resistance here in this particular area. You have a lot of investors that have accumulated the stock in this particular area that are looking to get out. So really kind of providing this bit of a head and shoulders formation that's starting to show up here in some of these names here. So I would be careful about tiptoeing into those stocks. Again, my preference is that when you get to some type of support level like this 20-day moving average, you sell a put credit spread. As you start to get a little bit more overbought, you start to sell that call credit spread. That's how I'm playing most of these names here. What's the difference between put verticals and credit spreads? Put verticals can be credit spreads. So you can trade a put vertical as a credit or a put vertical as a credit. So if we look at, let's say Activision here, we were selling a put credit spread here around 64 because we felt that it was going to rally, but not significantly higher here. So, this is the type of strategy that we would do, is we would sell a put credit spread here for a credit. So something like a $65, $60 credit spread here. Right now, you're only collecting $1.57, which is less than 1/3 of the width. We always want to try to collect at least 1/3 of the width here on this particular trade. So that is the example of a credit spread. versus a debit spread would be something like a long call vertical, where you buy maybe a $65 call and sell a $75 call. So the Home Depot trade that we made was a debit spread today. The credit spread that we sold for Activision is an example of a credit spread. So with that, I hope that this was useful in helping you guys set up your day in terms of understanding where the markets are headed, why it's kind of just in this flip-flop area. How do you actually position yourself during this particular time? And we'll keep doing this every few days, keep you updated. Things continue to change very, very actively. So what I'm telling you today might be completely different by Friday. So I hope that you're able to join us every single Tuesday, every single Friday. We're going to try to keep you abreast of what we're seeing. So thank you so much. We'll send out the recording here in a few minutes once we're done. And I hope you guys have a great Tuesday. Stay safe, everyone.